Hey everyone, it's Daniel here from Infovest. Hope you're all doing well. I want to talk about today about some mistakes that long-term investors make. Now, these are just my opinions that I derived from my experiences and learning along the way in this investment world as I invest in the markets. And I'm going to share a couple of things that could be helpful or beneficial for you. But keep one thing in mind, this is not financial advice. I'm not a registered financial advisor or investment advice. You should not take this as in any way in any advice. Always consult with a financial advisor and investment advisor that is registered before making any financial decisions. But let's talk about my opinions on how I run things and mistakes that I like to avoid when it comes to long-term investing. So the first things first is trading too much. You got to keep your trading activity, if you do any trading, versus your long-term investment portfolio completely separate. There should not be so much trading in your long-term investment portfolio because the goal at the end of the day is to accumulate enough money over the years, have it invested sitting there so that when you hit the retirement age, you're able to withdraw for your daily expenses. But if you're trading too much and you've got a goal here, your likelihood of reaching to that goal starts to diminish, and the probabilities of doing well starts to go lower and lower as you trade. Because if you try to trade to make a quick buck, then there will be mistakes, especially if you're new and you're not so savvy when it comes to investing and trading, and you try to make a quick buck because you think there's an opportunity, and you do it in your, let's say, in your investment portfolio, the investment long-term portfolio, the long-term bucket, definitely you're going to mess up how your returns will look like down the road. So don't try to beat the market. That should be left for another bucket. If you plan to do any trading, that should be left for your short-term bucket, right? Which is more of taking risks, money that you can afford to lose, money that you can afford to burn, money that you can afford to trade with. The long-term portion of it should not be touched at all. Maybe few balances and adjustments can be made, but you're not doing day trades every single day, running commissions on it and making big mistakes. So definitely this is one of the big mistakes that long-term investors can make because they want to make quick money. So focus on the long-term view, not on the short-term views. Now, the other one is emotional trading. Now, emotional trading can be, detrimental for any investor or trader, whether you're short-term or whether long-term. But trading based on emotions, like for example, if you're fearful that, oh, the recession's coming, the crash is coming, I gotta sell, 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 sell. And then you see the stock market go up. Oh my gosh, why did I sell? I'm gonna buy, 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 buy. And then you see the market's down, and then, why did I even buy? I'm gonna sell again. Avoid emotional trading. Emotional trading is gonna mess your whole long-term view, right? If your view is that you're gonna invest and you're going to use this money 50 years down the road, then why are you trying to trade and trying to outsmart the market? 50 years down the road, most likely, very likely, according to the probabilities and odds, you're going to see the stock market at a higher price than what it is today. If you don't believe me, pull up a chart of the S&P 500, look at 2023, and go all the way back to 1990, right? And even before that too, what do you see? A chart that just goes up and up and up. Yes, there are dips in the chart. There's no simple straight lines, right? Things just don't go up easily. Yes, there are dips, in the markets. But those are opportunities as a long-term investor to keep accumulating. Accumulate, and don't be worried about the dips. Now, if you're very worried, you can always hedge. There's a concept called hedging. Hedging, which means that you are still invested and you buy these insurances that if the market crashes, whatever amount of money that you lose, you can make up for some of them or all of it through your hedges, which could be through put options and etc. Right? Again, you got to be a little bit more sophisticated and understand how the markets and how these products work. Again, always consult with an investment financial advisor who can best guide you. If you're already educated by yourself and you believe you can do it yourself and do your own due diligence, then great, right? But there's no need to try to time the market. As a long-term investor, being in the market, so time in the market is better than timing the market. You're not here trying to time the market. Time in the market is better than timing the market. Just look at real estate as an example, right? Real estate is a beautiful example of time in the market is better than trying to time the market, because when you buy real estate and you hold on it and you sit on it for years, yeah, you'll see price appreciation, inflation, right? It's an inflation hedge. As inflation continues to rise, you'll see the real estate prices rise as well. As things get more expensive, sure, these asset prices will also move up. So time in the market is better than timing the market. But the problem is, right, it's the emotions. You're too eager. You need to make a quick buck. You want that bonus so you can go to Honolulu vacation tomorrow and you can enjoy your time there. Or you got to impress someone or something like that because you got to get that BMW. Stop it. Stop that. That's complete nuisance. You're going to burn your money for really no good reason, right? For reasons that even people don't even care about down the road, right? If you're going to burn your money, at least do it in a way where you enjoy, where you're going to enjoy something. So, if you're doing something to impress someone, then obviously it's not the best decision. You want to, if you're trying to go for vacation, save up your money, do your best, but don't mess up your long-term portfolio, your long-term goals, just for short-term pleasure, and that can and you'll see that if you avoid that, then sure you will do well in your long-term portfolio. Now, however, to contradict that point, there is an interesting book, and you can take a look at it. It's very interesting. It's the name of the book is called Die with Zero. And I don't remember the author completely, but it's a very interesting book. It talks about talks kind of against of what I was saying, right? I'm not saying completely forego your short-term pleasures for long-term. Of course, have short-term pleasures, but take a look at that book. It talks about enjoying the now with also keeping some sort of balance of your investment portfolio. And the idea is that by the time you hit retirement, you should, or by the time, not you hit retirement, but by the time you die, you should have literally zero in your bank account. So you should utilize, the utility of your money, you should utilize as much as you can, because you're not going to take it with you when you're dead. And it makes quite sense, right? But of course, don't go crazy where by retirement you have nothing and you need to work, but you can't, and you're going to struggle, right? Of course, have a balance of saving money, hitting your retirement goals. If you like to have certain pleasures now, just measure what would it cost you today and what it's going to cost you long term, and if it's worth it for you in terms of the happiness that it brings, then sure, right? because that's also another thing you need to consider, right? And I mean this from considering from, let's say, buying a car to impress someone versus taking that vacation to experience something in your life, right? If you're buying a car to impress someone, that's a pleasure that is not really worth the dollars. But if you're buying, let's say, a vacation for experience, for a lifetime experience, and it's going to cost you maybe this amount of money, and it's going to cost you this much earnings, future earnings, then if it makes sense to you, if it's going to bring you more happy than the interest that you're going to accumulate, then sure, do it. Because obviously when you hit that retirement age also, maybe you can't do that activity, you'll be too old, or there might be some health issues and so on. So understand the balance, right? I'm not saying completely, slave away and be slaved by the money, but have a balance. Understand what makes sense when it comes to your money, and what makes sense when it comes to making certain decisions for your long-term investment portfolio, and try to avoid certain mistakes and keep a good balance. Now, I diverted a little bit there, but I wanted to add that piece there just to see if it sparks your interest, especially in that book when the die with zero, right? So take a look if that sparks your interest. If not, let's continue with the mistakes. So the next mistake that long-term investors make is falling in love with an investment. Oh, I love Tesla. Oh, I love, Amazon. Or, oh, I love this marijuana stock. It's the future. I love Jeff Bezos. I love Mark Zuckerberg. Don't fall in love with the investment, right? You want to be as detached as you can, because if there is some sort of problem with that investment and it's not something that's going to meet your goals long term, then you should for sure get rid of it, right? So don't fall in love with investment and keep piling money in there. You need to look at it from a rational point of view. Look at it from, is this product that I'm investing in, am I doing it for just the love of investing in a company like this, or is it a rational decision for my long-term future? So that you need to distinguish. The other one is investing in things you don't understand, right? So if you don't understand crypto, or you don't understand, let's say, certain pharmaceutical stocks, right? Like for me, if you were to tell me to invest in some pharma companies making some sort of drug, forget it. I don't even understand half the stuffs that they're 99% of the stuffs and the lingos that they have there. It just doesn't make sense. Even if it's the future, the next, let's say, Amazon in the pharma business, if I don't understand, I don't understand it. And if I'm going to miss out, I'm going to miss out on it, right? The problem is that investors make is that they will invest in things that they don't understand, that they think are good, but then when they look at their portfolio, it's not reacting as how they thought it would. Then that's when you can get into emotional trading again. Now you're making decisions based on emotions, and you don't know what you're doing, and that you want to definitely avoid. The biggest one that I hear a lot is investing in get rich quick schemes. Everybody wants to get rich quick and fast, okay? The truth is that's not how getting rich works. That's not how investing works. There's no get rich quick schemes. There is, sure, you got lucky, or you prepared well enough and it took time and you made money, which may look like you got rich really quickly. That's also another example. But there's no get rich quick schemes, right? I hear a lot that people will invest their retirements into penny stocks because this mining company has found gold and it's going to be the next big boom. Always have your risk management in sight. Don't be fooled by the greed, right? Again, goes back to the emotions, right? Because you're stuck with greed, you're stuck with wanting more. It's like having a hook. If I take a fishing rod, and you might have seen a meme, something, somewhere online, where someone's running on the treadmill and they have a fishing rod, and at the end of the hook of the fishing rod, they put it over the guy or the girl who's running on the treadmill, and there's like a donut, right? So same thing. It's like you're on that treadmill in life, running, 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 and you're chasing this dollar bill, this money, right? So don't fall for it, right? Don't fall for it. I know it's difficult. It's easy said than done, but try not to fall for it, because that's just simply greed. If you just simply stick to principles, if you're simply disciplined, then you will avoid such catastrophe. You will be able to see much better returns in your long-term portfolio, right? Another mistake is not taking advantage of compounding growth and reinvesting. So just because you invest in the market one time doesn't mean that you should not contribute. You should continue to contribute. There's retirement funds out there that tell you how much you should contribute each year when you do your taxes with your accountant and you check up with the tax from your tax agency, how much you can contribute for the new year, right? Continue to contribute in those tax-free savings account. Continue to contribute, because as you contribute, no matter where you are in the market, whether we're in a crash, whether we're in a rise, whether we're in a sideways trading market, doesn't matter. At the end of the day, as you contribute, you will have compounding growth in with also the money that you're adding, which will expedite and bring exponential returns in your portfolio down the road, right? So if you don't, right, and you can do this through there's a lot of calculators on bank websites that show you, you put in a number, you put a contribution amount, and it shows you a graph where your money would look like if you contribute X amount of dollars every month, and in 30 years, 40 years, you'll have $500,000, something like that, right? So there are investing calculators out there on many bank websites. Check them out and do an analysis. If let's say invest $10,000 and you don't contribute and you let that grow, what would it look like? If you invest $10,000 and contribute $1,000 a month, what would it look like? So prioritizing that, after you pay your expenses and you've got some cash left, prioritize that cash to be utilized for your long-term portfolio, and then the rest for your other pleasures and expenses. At least contribute some amount, because the compounding growth plus the reinvestments will accumulate, and you will see over the years you will have a huge amount to withdraw from when it comes to retirement. Now, another mistake is watching your portfolio every hour. Logging in. How's my portfolio doing? How's my portfolio doing? Relax. It's not going to matter in 50 years, right? What your portfolio is doing today. If you're investing the right way and you're not, making these mistakes, and you're not investing in junk investments and penny stocks, then you'll be fine. If you invest in simply, well-known, reputable indexes, mutual funds, ETFs, I prefer more ETFs, but you invest in indexes and you're well balanced and you've got the help from a financial advisor and so on, you'll do fine. You don't need to look at your portfolio every damn second, right? So the last one that I'll leave with you guys, another mistake, is taking random advice from the media, from friends, right? hearing Warren Buffett has invested in this stock. My friend, my neighbor invested in this mining company. Or this media said this is the next stock that's going to blow up. Stop it. Stop it. Really, it goes back to the past mistake that I talked about, that investing what you don't, don't invest in things that you don't understand, right? Do invest in things that you understand, but investing in things that you don't understand plus random advice, again, you're going to get emotions into this. You're going to invest in it. You're going to see it's not performing well, and then your emotions going to kick in, and then you're going to probably most likely sell at a loss, right? So just because someone else is doing something doesn't mean that you have to do it. Well, if it makes sense to you, then do your due diligence for sure. If a friend recommends a stock to you, or you read something online, do your due diligence, and if it makes sense, then you decide to pull the trigger. Not that my friend told me, buy this marijuana stock, it's going to the moon tomorrow. Doesn't work. It doesn't work, right? You may get lucky, maybe, but always do your due diligence. So the idea is, when you're managing your investment portfolio, you want to avoid emotions. You want to make sure that you have more rational thinking, you have discipline involved, and you're not touching it too much, because the idea is for your long-term portfolio is to hit retirement with a good amount of money where you can withdraw from. Your other portfolio, your other baskets, if you've got extra money, cash to take more risk, then you can do whatever the heck you want to do with your short-term portfolios and whatnot, right? It's totally up to you, right? But your long-term portfolio, think of it as a hedge against all your other mistakes that you will probably make in your short-term portfolio, right? So even if you make a short-term portfolio, let's say you got two. You've got a short-term bucket and a long-term bucket, right? So long-term bucket, you keep piling in money, it's growing, don't touch it. Touch it when you get to the 65 age, right? That's another rule that I forgot, is people who keep touching their long-term portfolio because they got to build a deck in their backyard, or they got to buy that car or whatever, right? So try not to touch that portfolio. It's more, when you invest and you send money in, it should sit there and never be touched unless there's really an emergency and you have to, right? So you got your long-term bucket, don't touch it, let it be, keep growing it. And then you got your short term, right? Where you're going to do all kinds of crazy things. You're going to mess up 100%, right? So if your short-term bucket, let's say, blows up, let's say you put 10 grand in this one and you're trading, and boom, it blew up, right? Like, you lost all your money. And then at least your long-term bucket's there to say, hey, don't worry, you still got money here, but hey, don't touch it. Also, don't take that money to go in the short-term bucket. But hey, don't worry, you're still on track for full-time, for retirement down the road, right? That's how I view it. Let me know how you view your buckets, your investing style. Leave a comment below, subscribe, hit the like button and the bell icon to be notified on the next video. And I'll see you guys around. Cheers. Bye.